Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, April 6, 2010. We start today's broadcast with a look at the Reserve Bank of Australia, which boosted its interest rates, its benchmark interest rate, by 25 basis points to 4.25% in its meeting that concluded during Tuesday's Asian session. It was the second meeting in a row that the RBA governor hiked rates by a quarter point, and it's now the fifth time in the past 6 meetings in which he has done so. The move underlines the central bank's confidence in the strength of the recovery as it now firmly seeks to control price pressures. RBA Governor Stevens did warn that housing prices were rising too high, and today's decision is a further step to returning interest rates to average levels. Here we take a look at the Australian dollar US dollar pair, and we had seen that prior to the release, the previous four or five sessions, we have been stuck in this ascending triangle pattern with a horizontal level of resistance around 0.9215 and 20, and this upward sloping line of support. Prior to the release, we had broken below that short-term support line in what was pump fake in the market, in which first we have a move down, but then it's followed by a very strong move up. So following this down move, where we tested support around 0.9160, we had our RBA release, and as you can see, we pushed above this resistance that had held for all of last week. Following a test of 0.9250, which was our high back here in March 17th, we moved back down to retest this level of resistance as support. Following that test, we had another surge upward as we moved above this March 17th high, reaching 0.9280. If we zoom out to a daily view, we see that today's high goes back all the way to January 15th. So we have now our next resistance level around 0.9327, and above that at our high for 2009 at 0.94. We can see that the Aussie was boosted by a nice rally in gold prices, which moved above the 1,133 resistance, or yesterday's high, and reaching today's high at 1,138. So that pushed above this resistance from March 17th. Coincidentally, that was our high in the Aussie US dollar pair, and now we approach this level near 1,144.50 back in early March. So that had been our high in gold prices for 2010. So we could see that we had a rather strong boost in New York trading in gold prices, and that helped the Aussie to move above the 0.9250 area. Our second main commodity currency pair is the US dollar Canadian dollar pair, and we saw it push further lower today, extending the decline we had to start the week. So we came in just below 1.01 to start this week's trading, and in today's trading we reached the parity level in early New York trading, and then we consolidated around there throughout the rest of New York trading. Oil prices remain above the $86 barrel level, and the Canadian dollar is being strengthened by prospects of higher interest rates, as it has shown very good fundamental data recently. Turning away from our commodity currencies, let's look at the euro-dollar pair. In today's trading, we saw the euro sold off after Europeans came back from their 4-day Easter holiday, as we had renewed concerns over Greece. First, there were rumors that Greek officials had wanted to amend its deal with the European Union, in which they would be able to bypass the IMF in order to avoid the lenders' tough conditions. That report was denied by a senior Greek official, but still gave the market pause. Second, there was a dispute about the rate that Greece could borrow from the EU if it needs to tap into that source of funding. Germany believes that the rate at which Greece can borrow should be around 6% to 6.5%, which is close to prevailing market rates and may be too high for Greece to afford. Adding to Greece's woes, we also had a report that showed that up to 3 billion euros worth of cash deposits held by Greek households and companies had left the country in February following a 5 billion euro exodus in January. So the country's wealthy citizens and corporations are redeeming their cash deposits and sending them offshore. So markets responded to all of this negative news and heightened uncertainty by pushing up the rates for Greek bonds, widening the spreads between the Greek and German bonds, and pumping up the rate on 5-year credit default swaps swaps, that being the rate to insure against a default. So all of that combined took us from around 1.3480 to start today's session down to a low of 1.3354. So you could see that wiped away the gains the euro had seen in last week's trading, and now we test the 1.3350 area, which brings us back to the levels just after the announcement of the EU and IMF Greek deal. So we'll see if this pressure on the euro continues the rest of the week after perhaps we have some pullback to the slide we had already. In a look at the dollar-yen pair, we see that the pair moved in favor of the Japanese yen in today's trading, extending its gains in favor of the yen following our test of 94.60 over the weekend. So that has paired some of the losses the yen had suffered in last week's trading. Yields on US Treasuries fell today as we had a pretty strong demand for the government sale of $40 billion worth of 3-year notes. Also, we had the FOMC meeting minutes come out, and in it, Federal Reserve officials saw signs of a strengthening recovery. However, they did say that it could be hobbled by high unemployment and tight credit, and there was some warning of raising rates too soon, according to the minute. Fed officials are looking for signs of self-sustaining growth before they begin their exit from the most aggressive monetary policy in history. Now, they also wanted to convey that the extended period language on keeping rates at their ultra-low levels should not be considered a 6-month guarantee of moving rates. In the minutes, quoting from the minutes, such forward guidance would not limit the committee's ability to commence monetary policy tightening promptly if evidence suggests that economic activity was accelerating markedly or underlying inflation was rising notably. So we have now the condition before tightening rates be some type of increase in the economy or in inflation. So, while the Fed wants some flexibility on how the market interprets the extended period language, it does not intend to use it, judging by the dovish tone of the minutes. In a quick look at the pound, we saw that it started today's session sliding rather sharply from a high around 1.53 down to 1.5130, as we had further evidence that we may have an election in which there is no clear winner, which has been pressuring the pound in recent months. However, after we tested this support, which came at around the 38.2% retracement of this rally we've had since March 26th, we had a rather strong move back above 1.5250 as the pound paired most of its overnight losses. So that shows some buying support for the pound after its earlier dip. If we look at the euro-pound pair, meanwhile, we see that the pound gained strongly against the euro, pushing below the 0.88 level. And if we zoom this pair out, we see that our current low goes back all the way to February 24th. So the weakness in the yen and the ability of the pound to win back some of its overnight losses definitely favored the pound in the euro-pound pair. So we could see that the recent Greece worries have pushed this pair down from the 0.91 area it had seen earlier on in March down to 87.70 as of today. So that will do it for our highlights. Let's take a look at the upcoming fundamental session. Tonight at 7 p.m. we get UK data on shop price indexes as well as consumer confidence. At 7:30 p.m. Australia posted services PMI, and that will be followed by the Bank of Japan interest rate statement. Overnight we get retail sales data from Switzerland, the services PMI from the UK, the fourth quarter final version of GDP, and producer prices from the Eurozone, as well as Germany factory orders. Tomorrow in Canada we get data on building permits as well as the IV PMI, while the US has just one release in the afternoon, that is consumer credit. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.